Jim Lebenthal, I'll turn to you first because you told our producers you think this could be the week that it breaks down.
Yeah, and it is the S&P 500. Obviously, we're all aware of what the Nasdaq's been doing. It has broken down. But if you have even a modicum of attention that you've paid to valuation, you're not getting your rear end handed to you. It's really the S&P 500 that if you're a diversified investor, you're paying attention to. So here's the deal. It's been 15 months since you've seen more than a 5% decline in the S&P 500. Every dip during those 15 months has been bought, and I believe that's because of the cash that the Fed's been injecting into the financial markets. So with the Fed pulling back, this is it, all right? If we get down to 45.30 on the S&P 500, which is 6% down, then I think we are getting that 10% correction, which I've been calling for this quarter. And frankly, I believe it's going to happen. I also believe it's healthy. All right, trees don't grow to the sky, and it's about time that investors realize that valuations matter and that volatility normally does show up in the form of a correction at least once a year. So none of this is head for the hills and, cry to your mother. This is just buckle your seatbelt and get through a correction that's led by higher interest rates and a less accommodative Fed. But by no means is the bull market over. The economic expansion is still early, and so the bull market will stay intact. You just got to get through this.
Yeah, well, I mean, trees don't grow to the sky, right? I'll give you that. But, I mean, the timber effect doesn't feel all that great if you think that that's where we could be heading on the S&P. Josh, you've been focused a lot on the Nasdaq, pointing out the 200-day moving average was probably the most important thing that you were looking at. We're below that now. 14,731. Yeah. Was the line in the sand. You could see where we're trading now. We're pretty much at the lows of the day. I've got on the Nasdaq 14,624. And this was something that you said you need to keep an eye on because if you close below this, especially towards the latter part of a week, you could get a timber.
So there's a couple of things going on here that I would mention with respect to that. Last week, we were talking about how it just didn't look as though the Nasdaq was done with the work that it had to do. And I agree with Jim's point. The S&P 500 is the market, but frankly, the Nasdaq is like the real market because the biggest components in the S&P are mostly the big Nasdaq stocks. And when you think about a Nasdaq composite that's now 7.5% off its high, we know historically that could get way worse before a lot of these stocks find the bottom. So nothing's changed in the way I'm looking at it. I think we have more work to do. What has changed maybe is that it's starting to become more noticeable that the rest of the S&P is succumbing to that. And so just think about financials, right? Down 2% again today. You had good earnings from JP Morgan. You had good earnings from Goldman Sachs. Obviously, they don't have the same loan loss reserves that they can stuff the cookie jar with. But, like, those businesses are on fire right now, and they can't catch a bid. The XHB, housing, another business absolutely on fire, now trading at its lowest level since October. Transport selling off. And with the supply chain in the shape that it's in, we know that transport-related businesses are doing great. They have more demand than they have supply. Doesn't matter. They're selling off. And now you look at the Russell, which is back at previous support. It's hit this level, I don't know, a dozen times. This time it doesn't look like it's going to hold. And that's happening at the same time that you have mega cap, really important names to the market, like Amazon. Netflix is at almost a 30% drawdown. Looking very heavy, no buyers in sight. So you just have to sit back and say to yourself, this is bigger than any one stock pick that I have, right? You're in an environment where you could see a name that you buy go up 5% on Monday, down 6% on Tuesday, up 4% on Wednesday. There's no meaning. It's a much bigger story. It's not about that stock that you are fixated on. So the good news is, number one, once again, the Fed is letting the markets do its work for it. You now have a situation where a 10-year is 1.8%. You have a 5-year at 1.6%. You have a 2-year Treasury at 1%. So the Fed is letting the market do the tightening for it, which means it will have to do less as it starts to move. That's good. And then the second thing, Judge, for our viewers, the second thing, let the market come to you. Now you don't have to chase. Now we're not trending. You're not losing your mind like you're missing out. Now stocks are coming to you. Be patient. It's a much better environment for people who are trying to invest then new record highs every second of the day.
Yeah.
And if you look at those positives, I think you're fine.